Well, good morning. Welcome to the Financial Pulse Radio Show. I'm your host, Danny Howell, CEO of East Coast Tax and Financial Planning. Welcome. Hope everybody's had a great week so far. It's been an interesting week and a half, 2 weeks with this stock market bouncing around like it has been. It's had a lot of people asking a lot of questions, particularly, how's my account doing and where do we stand? And it's a wake-up call anytime we see these drastic moves. I mean, we actually saw the Dow dip as far as points, not percentage, but points in one day, the largest in history just this week. So we've seen lots of things happen, and it really begs the question of, are you in the position, proper position according to your risk tolerance and what your goals are, particularly if you're close to retirement or in retirement. Fundamentally speaking, our unemployment rate is literally historically low right now. The economy is moving along. There's a couple little hints where wages aren't necessarily keeping up with some of the growth, but nonetheless, overall, things are going pretty well as far as fundamentally speaking. Now, if you look at the rest of the globe, it's not so hot. Here in the U.S., we're experiencing, record unemployment rate. We've experienced record highs in the market, and consumer spending, discretionary spending, confidence, people going out and buying things that they don't necessarily need but that they want. That is very strong right now going into the holiday season. But there's a couple things that we need to think about when we're thinking about investing money in the market, particularly if we're close to retirement or already retired. And that is basically what's going on in the rest of the world and what's going on with Fed policy, and then also looking at a big-time election, big midterm election that we have coming, just here less than a month away. So all these things have reason to cause markets to get jittery. The Fed came out and raised interest rates and hinted that they were going to raise them again before the end of the year. And that makes companies really nervous. It makes investors really nervous because Wall Street, when things are going well, they just don't want any kind of change. They just want things to continue to go well. They want to know, they want to have a quantifiable understanding of where they are and where things will be. But when you enter in monetary policy, the Fed coming in, making announcements of changes that could affect markets in a tremendous way, particularly in bond markets and so forth, and the easy flow of capital, when companies can borrow money at cheap rates, gives them a lot of confidence to be able to go out, raise capital, and invest in their company and create growth. So when those things are at risk, especially in a market that's done so well for so long, then there is sell-off, there is correction, there is nervousness, and there are thresholds that are met that cause things to go down even further, meaning big trading firms, institutional firms have mechanisms in place. Once a stock price or the market gets to a certain place, they sell down even more. So just looking at all of those things, with the elections coming up in November, there's a lot of speculation on what that could do. But if you look at where this market is and the fact that things have been going so well for so long, a lot of times what ends up happening is the market in general looks for reasons to sell rather than looking for more reasons to buy. They're always looking for reasons to buy, but the fever becomes more of like, okay, is this today that we're going to see these tremendous drops again? And if we look at the November elections and how important those are, there's a lot of talk amongst if Democrats get put in office, how they may go to raising taxes and trying to get rid of a lot of the key aspects to the Jobs Act that was passed at the end of last year. And so obviously those big tax cuts for the corporations and even people in general seeing their paychecks being larger, and that in turn creating more confidence in discretionary spending, that puts a lot of that stuff at risk. I'm not getting political. It just is what it is because that's what they've been saying. On the other side, if Republicans end up maintaining the House and the Senate, then I suspect that a lot of the markets are just going to kind of hum along like they have been because, again, they don't like change. But if we see more interest rates increases, and then we maybe see a change of power, and then there's that uncertainty, it's not a matter of whether Democrats are right or Republicans are wrong or vice versa. It's just a matter of what the market is comfortable with. And the more predictability that the market can see as far as sustainability of things going well, the better off it's going to be. But once they think that there is going to be something that's going to disrupt what's been going on, then that's when you start to see a little bit of jitteriness and a possibility of people taking more off the table in profits and selling off, creating a downturn in the market. So that's all speculative stuff, folks. But at the end of the day, it's just what we have to keep a really close eye on and looking at to make sure that we're positioned properly going into some of these uncertain times and some of the things that we've just dealt with. And if you look at the rest of the world, the emerging marketplace, international investing is very challenging. When you see currency issues in Brazil and Venezuela and Turkey and how that's caused mass inflation. And then you look at what's happened in China and some of the different other countries because of a lot of the tariff talk and the tariff wars. So there's a lot of things out there that are risks to the market. And there always is things, but just knowing what those things are and understanding so you can make sure that whatever risk you're taking that you're absolutely comfortable with. And when things like this happen, when we've seen, if you haven't watched the news much and you haven't really paid attention, the stock market has been selling off quite a bit. We're not in bear market territory by any stretch of imagination, but there has been a correction, and we saw a couple rebounds here in the last couple sessions. So some of it's coming back, but nonetheless, that's when you really want to have a conversation with yourself and even your existing financial advisor of, okay, how much risk am I actually taking? What's my downside potential in my portfolio? So that if I look at that number, and especially if I'm almost retired or in retirement, and I'm really uncomfortable with that downturn, the potential of what my investments are willing to do, what my investments have the potential to do, that's when I really have to do a gut check and see if I need to make some changes in my portfolio. A lot of people say we can't be emotional when these markets do these type of things, but money is emotional because we work so hard for it. So in that regard, your risk tolerance in a market that's not doing so hot might change compared to maybe when things have had a prolonged good run. And you might say, well, how can you be consistent if you're going to switch from back and forth? And I'm not saying that you need to constantly be switching. What I am saying, though, is you need to be constantly asking yourself the question, what am I most comfortable with in different market environments? So that when you see a correction, it's not a panic. It's okay, I'm still within my tolerance, within my comfort zone. So I should be okay. I know when things are going to start to get out of my comfort zone, these are the changes that we're going to make. And it goes back to the investment policy statement that I've talked about in the past when we talk about overall financial planning. The investment policy statement is so important. It outlines how much risk you're willing to take for the reward that you desire, and also ensures that you understand what the absolute worst case scenario when we back test an investment strategy against maybe a 2008 or early 2000s when we saw major corrections in the economy. And that way it'll help you sleep at night knowing that you can make smart financial decisions, making smart risk decisions. There's nothing wrong even if you're listening to the show and you say, I don't want to take any risk at all, zero risk. There's still ways to grow your money in a zero risk environment. You just have to understand that obviously with more risk comes the potential for more reward. Well, we're going to come back, and when we come back to the next segment, we're going to talk more about risk. We're going to talk about the market, things to watch out for, and just really some strategies to put yourself in a place of choice and control so that if we see some things throughout the rest of this last quarter with the elections, with the fact that interest rates are going up, some of these things have been rattling the markets, to avoid some of the pitfalls of what some of these huge downturns and sell-offs could do to your portfolio. I'm Danny Howes with East Coast Tax and Financial Planning. You're listening to The Financial Pulse. We're talking about what's going on in the market right now. We'll be back right after this segment in just a bit.